It's the afternoon of January 17th, 2025, and your screen is lying to you. Right now, if you turn on CNBC or scroll through the usual financial channels, you'll see the same tired headlines. Gold is up, silver is volatile, Bitcoin just did something. The talking heads are arguing about whether precious metals are overbought or whether crypto is the future of money. And if you're watching the mainstream coverage, you'd think those are your only options for protecting wealth in this economy. But here's what they're not telling you. While everyone is obsessing over silver's latest 3% move and debating whether gold can hit $3,000, there's one metal sitting quietly in the background that just made my hair stand up. Copper, $4.85 per pound, holding steady like it's bolted to the floor. Now, I've been analyzing commodity markets for over a decade, and I built Hidden Wealth specifically to cut through the noise faster than the mainstream can spin it. I'm not here to feed you hype. I'm here because I saw something this week that I couldn't wait for some talking head to finally report. While everyone is watching the shiny metals, I'm watching the shadow market. And what I saw is this. Amazon Web Services just signed a direct 2-year offtake agreement with Rio Tinto for copper. Not through the London Metal Exchange, not through COMEX, direct, bypassing the entire public market. Samsung is doing the same thing. Microsoft is stockpiling. These aren't speculative trades. These are strategic acquisitions of a resource that the world's largest technology companies have decided they cannot afford to be without. So let me ask you something. If copper is just another boring industrial metal that's about to crash with everything else, why are the biggest corporations on the planet locking in multi-year supply contracts right now? Why are they willing to pay above market rates to guarantee delivery? The screen is telling you one story. The shadow market is telling you another. And if you think silver's daily volatility is the real story, you're about to miss the tectonic shift that's been building beneath the surface for decades. Because what we're witnessing right now isn't just a market rotation. It's the moment copper stops being treated as a commodity and starts being treated as the strategic asset it actually is. Copper is the new gold, and the institutions are front-running the public before most people even realize there's a shortage coming. Here's my primary claim, and I need you to understand this clearly because everything else in this breakdown builds from here. Copper is no longer just an industrial commodity. It is becoming a strategic technology asset that Amazon, Samsung, Microsoft, and every other major player in the AI and electrification space are securing before the public markets even wake up to the structural shortage. This is not about short-term price action. This is not about riding some hype wave or catching a quick trade. This is about recognizing a fundamental shift in how the world's most critical infrastructure metal is being valued and allocated. We are witnessing what I call the great decoupling. Silver and gold are being treated as fear trades, insurance policies you buy when you're scared the system is breaking. And don't get me wrong, I understand the appeal. I've been in that world for years, but copper is being treated differently. Copper is being treated as infrastructure oxygen. It's the metal you need if you're building the future. AI data centers, electric vehicle fleets, renewable energy grids, high-speed rail. Every single piece of technology that's supposed to power the next 20 years of human civilization requires massive amounts of copper. And here's the uncomfortable truth that the mainstream financial media does not want to talk about. Supply cannot respond to this demand for at least a decade, not because of some temporary bottleneck, not because of a logistics hiccup, but because of the fundamental physics of mining. So in this breakdown, here's what I'm going to do. First, I'm going to walk you through the exact market structure we're seeing right now, the specific price action, the inventory data, the institutional positioning that's happening in real time while the mainstream is still writing yesterday's headlines. Second, I'm going to break down the copper to gold ratio. This is the single most important signal for understanding when the market is shifting from defense to offense, from fear to growth, from precious metals to industrial technology metals. Third, I'm going to run the math, not the hopium math, the actual supply-demand numbers that show you why $5 per pound is not some bubble top. It's the new floor for a world that has no choice but to electrify. Fourth, I'm going to steelman the strongest argument against this thesis. Because if I can't defend against the best counter-argument, then I have no business making this case on Hidden Wealth. And finally, I'm going to share my personal approach. Not advice, not recommendations. Just the exact triggers I'm watching and how I'm thinking about this as it unfolds. This isn't a trade for tomorrow. This is a cycle signal that has been building for decades. And the promise is this. By the end of this breakdown, you will understand why the real story isn't the volatility you're seeing on your screen today. It's the shadow withdrawals happening at the London Metal Exchange that nobody is talking about. Let's get into it. All right. So let me give you the snapshot of what I was looking at yesterday afternoon, January 16th, early afternoon Eastern Standard Time. Gold sitting at $2,115, down about $18 on the day. Silver at $30.45. experiencing another volatile session with retail traders getting whipsawed by the usual paper market games, and copper at $4.85 per pound. Now here's what's critical about that copper price. While precious metals are chopping around while the headlines are focused on whether silver can break 32 or whether gold is due for a pullback, copper is holding firm, not rallying, not mooning, just holding. And in a market like this, that stability is more telling than any moonshot could be. Now, let me explain what I mean. When you look at the technical structure for copper, you're seeing a high liquidity battle zone at the 480 level. Despite the broader risk-off sentiment in equities, despite the volatility in precious metals, despite every reason copper should be selling off in sympathy, it's refusing to break lower. This is what I call tectonic stability. It's not flashy, it's not exciting for the day traders, but it's the kind of price action that tells you there are very large hands underneath this market who are not willing to let it break. Now, contrast this with what's happening in silver. Silver is experiencing what the market calls a red flush every other week. It's emotional, it's volatile. It's driven by paper traders who are selling out of fear, responding to headlines, trying to front run what they think is the next big move. But here's where the paper market and the physical market are telling you completely different stories. While paper traders are getting shaken out of their silver positions, physical giants like Amazon Web Services are signing multi-year direct offtake deals with Rio Tinto for copper. Think about that for a second. AWS isn't speculating. They're not trying to flip a commodity for a quick profit. They are securing long-term supply contracts because they have done the math on how much copper they need to build and maintain the data center infrastructure that powers their entire business model. And they are willing to bypass the public markets entirely to guarantee that supply. This isn't normal behavior during a commodity downturn. This is unusual behavior that should be setting off alarm bells for anyone paying attention. So you have to ask yourself, what do they know that the paper markets don't? The silver volatility on your screen is real. The fear is real. But the shadow withdrawals happening at the LME, those are real too. And the institutions are telling retail to focus on the precious metals drama while they quietly hardwire their data centers with the very metal the public is ignoring. I've been watching commodity markets long enough to know that when there's a disconnect this large between what the screen is showing and what the physical market is doing, you need to pay attention to the physical market. Because the screen can lie. Sentiment can shift. Paper can be printed, but you can't print copper mines. Now, I need to slow down here because this next part is the foundation for understanding why this matters. We're going to talk about the copper to gold ratio. And I know ratios sound boring. They sound like something you'd see in a textbook that puts you to sleep. But this ratio is the economic seesaw. And right now, that seesaw is tilting in a direction that most people aren't prepared for. Let me break this down. The copper to gold ratio measures the market's preference between two fundamentally different types of assets. On one side, you have gold, the ultimate defensive asset, the emergency fund, the insurance policy. On the other side, you have copper, the industrial workhorse, the infrastructure metal, the thing you need when you're building the future. Think of it like this. Gold is what you buy when you're scared, when you think the system is breaking, when you don't trust currencies, when you want to preserve wealth in a form that has held value for 5,000 years. Copper is what you buy when you're building. When you're laying electrical grids, when you're manufacturing EVs, when you're constructing data centers and renewable energy infrastructure, you buy insurance when you're scared, you buy wiring when you're building the future. So the ratio between these two metals tells you something profound about where the market thinks we are in the economic cycle. When the copper to gold ratio is falling, it means the market is rotating into defense. People are scared. They're buying gold. They're selling industrial metals. This typically happens during recessions, financial crises, periods of extreme uncertainty. When the copper to gold ratio is rising, it means the market is rotating into offense. People are building. They're investing in infrastructure. They're betting on growth. And here's the trap that most precious metals holders are walking into right now. They've been conditioned to see gold and silver as the ultimate safe havens. And in many scenarios, they are. I'm not disputing that. But when the ratio starts to turn higher, when copper starts to outperform gold, it signals a shift towards cyclical industrial utility assets. And if you're holding only defensive assets during that shift, you're positioned for the last war, not the next one. Let me give you the analogy that finally made this click for me years ago when I was trying to understand commodity cycles. Imagine you're in a war. In the early stages, when you don't know if you're going to survive, when chaos is everywhere, you stockpile ammunition, you dig bunkers, you focus purely on defense. That's gold, that's silver, that's the fear trade. But at some point, if you're going to win the war, you have to go on offense. You have to build supply lines, you have to manufacture tanks and equipment and all the industrial capacity you need to actually project power. That's copper. That's the growth trade. And what the copper to gold ratio is telling us right now is that the market is starting to shift from bunker mentality to build mentality. Now here's the pattern interrupt I need you to see. This isn't just theory. This isn't some abstract macro concept. Look at the AWS deal. Look at Samsung. Look at the fact that LME inventories have been quietly declining while corporate offtake agreements are accelerating. The rotation isn't coming. It's already here. The institutions just haven't announced it on the ticker yet. All right. Now we need to run the numbers because if I can't show you the math, then this is just another hot take in a sea of financial noise. Let's start with the demand side, specifically the EV and data center gap. A traditional internal combustion engine vehicle uses about 20 kilograms of copper. That's your wiring, your starter motor, your alternator. Basic stuff. An electric vehicle uses approximately 80 kilograms of copper. That's 4 times the copper intensity per vehicle. And we're not talking about a marginal shift in the auto industry. We're talking about every major automaker on the planet committing to full EV lineups within the next 10 to 15 years. Now take that and multiply it across global auto production. We're looking at roughly 80 million vehicles produced per year globally. If even half of those transition to EVs over the next decade, you're talking about an additional 2.4 million metric tons of copper demand just from the automotive sector alone. But it doesn't stop there. AI data centers are the wild card that nobody was pricing in 5 years ago. A single large-scale data center can require anywhere from 5,000 to 10,000 metric tons of copper for cooling systems, electrical distribution, backup power, and high-speed interconnects. And we're not building 1 or 2 of these, we're building hundreds. Microsoft, Google, Amazon, Meta, they're all in an arms race to build AI infrastructure. And every single watt of computing power they add requires copper to keep the system from melting down. Then you have renewable energy grids, solar farms, wind installations, grid-scale battery storage. All of it is massively copper intensive. A single offshore wind turbine uses approximately 8 metric tons of copper. A solar farm uses about 5 metric tons per megawatt of capacity. The International Energy Agency has projected that to meet global climate goals, we need to triple renewable energy capacity by 2030. That's not an optimistic forecast. That's the bare minimum to stay on track. So when you add up EVs, AI data centers, renewable grids, and baseline industrial demand, you're looking at a multi-decade locked-in demand profile that hasn't existed in human history. This isn't cyclical demand that goes away when the economy slows down. This is structural demand that's baked into the infrastructure requirements of modern civilization. Now let's talk about the supply side, because this is where it gets uncomfortable. New copper mines take 12 to 15 years to come online from discovery to production. That's not an exaggeration. That's the average timeline when you account for exploration, permitting, environmental reviews, financing, construction, and ramp-up. And here's the kicker. Ore grades have dropped 30% since the year 2000. What that means in plain English is that mining companies have to move 30% more rock to extract the same amount of copper. The easy copper has already been pulled out of the ground. What's left is deeper, lower grade, and more expensive to extract. Let me run a simple stress test. If global copper demand grows by just 3% per year, which is actually conservative given the electrification trends, we need an additional 750,000 metric tons of new supply every single year just to keep pace. But there aren't enough new mines in the development pipeline to meet that growth. According to the most recent data from S&P Global, the copper industry is facing a cumulative supply deficit of nearly 10 million metric tons by 2030 if current trends continue. 10 million metric tons. That's not a rounding error. That's a structural gap that cannot be bridged by recycling or incremental efficiency improvements. And speaking of recycling, let me kill that myth right now. Yes, copper is highly recyclable. About 30% of global supply comes from recycled material. But here's what the recycling optimists always leave out. Recycled copper cannot meet the high purity standards required for advanced applications like AI high-speed cooling systems and next-generation EV. You can't just melt down old pipes and turn them into semiconductor-grade copper. The metallurgy doesn't work that way. All right, let me pause here and do something that I think is critical. I need to steelman the strongest argument against this thesis, because if I can't defend against the best counter-argument, then I'm just another talking head pushing hopium. So let's recap where we are. We've established that AWS and Samsung are signing direct offtake deals, bypassing public markets. We've seen that copper is holding support while precious metals chop around. We've broken down the copper to gold ratio and the macro rotation from defense to offense. And we've run the math on the structural supply deficit. Now here's the strongest case against this whole thesis. Recession will kill demand. And I'm not talking about some shallow 6-month slowdown. I'm talking about a prolonged global manufacturing recession where demand collapses and copper gets crushed along with everything else. This is a legitimate concern. So let me address it directly. First, let's acknowledge that, yes, copper is cyclical. In a severe recession, demand would take a hit. I'm not going to pretend otherwise, but here's where the traditional cyclical playbook breaks down. The direct corporate deals prove that tech giants don't care about short-term economic cycles. They care about availability. Think about what AWS is doing. They're not speculating on copper prices. They're de-risking their supply chains because they know that if they wait for prices to crash and then try to secure supply, the supply might not be there. This is locked-in demand. If you're Amazon and you need to build a data center to support your AI services, you can't just delay that project indefinitely. Your competitors are building. You're either securing the copper you need now, or you're falling behind. Could a deep recession slow the pace? Sure, but it can't eliminate the structural need for electrification. And here's the critical point. Supply can't respond quickly, even if demand slows. If mining companies cut back during a recession when the economy recovers, the supply deficit is even worse than before. The second counterargument is that recycling will save us. I already addressed this. Recycled copper cannot meet high purity standards for advanced applications. It helps with baseline demand, but cannot fill the gap for high-tech growth sectors. At the end of the day, you can't print copper mines. So now let me share how I'm personally thinking about this. And let me be clear, this is not advice. This is not a recommendation. This is just me sharing my own triggers and how I'm approaching this setup. I'm watching the copper to gold ratio weekly. If it continues to turn higher, while silver remains volatile and range-bound, I'm personally focusing more attention on copper exposure. That doesn't mean I'm abandoning precious metals, but in terms of where I'm looking for asymmetric upside over the next 12 to 24 months, I'm shifting attention to the industrial technology metals. For retail exposure, I'm looking at the Global X Copper Miners ETF, ticker COPYX. This gives diversified exposure to the largest publicly traded copper miners with operational leverage to copper prices. My specific triggers are these. If copper closes the week above 480 despite a broader market sell-off, I'm looking to add exposure. That would signal the structural bid is real. If copper breaks below $4.20 on a sustained basis, I step back and reassess. That would tell me the recession fears are temporarily winning. The goal isn't to get rich overnight. It's to position on the right side of a multi-year structural trend. Here's my 3-sentence recap. Silver is the headline, but copper is the long chapter that comes next. The AWS and Samsung deals are the first drops of a coming corporate tsunami where tech giants bypass public markets to secure strategic supply. The macro rotation from precious metals to industrial technology metals has already begun. The market just hasn't announced it on the ticker yet. Don't let the volatility on your screen blind you to the tectonic shift happening in the physical world. The era of copper as just another industrial commodity is over. The era of copper as strategic technology gold is here. And while the mainstream is debating silver and Bitcoin, the smart money is quietly securing the one metal that can't be printed, can't be synthesized, and can't be substituted. The question you have to ask yourself is this: are you going to position for the world as it was, or the world as it's becoming? The precious metals drama is for yesterday. The copper supply crisis is for tomorrow. And tomorrow is closer than most people think. If you got value from this breakdown, subscribe to Hidden Wealth. I'm cutting through the noise while the mainstream is still writing yesterday's headlines. I'll see you in the next one.